Welcome to the 8th episode of Property Dollar. We have Tyrone from Washington Brown here with us.
And someone said to me, well, you didn't get the marks. Why don't you do this thing called construction economics?
Construction economics.
At UTS. And one day I went to university, and on the columns there were these job ads that said, cadet wanted, Washington Brown. Because I felt old, I thought, I've got to get into the industry. So I went and stole all the job ads. So I was the only one that turned up. Right? You claim the wear and tear of that ute against the taxable income of the business. It's the same thing in property. You claim the wear and tear of the property against your taxable income. Everything else from the bricks, the concrete, the ovens, the dishwashers, the blinds, even things like the design of the building forms part of the construction costs.
When someone buys a brand new property, how long they have to wait to book a depreciation?
If you came to us 6 months later, the report won't be any different. We backdate it to when you settled, regardless of when we do the report.
Good day, folks. Welcome to the 8th episode of Property Dollar. Folks, I love you so much, and thank you so much for giving us all the support. And I can see that in the downloads that we are getting, in the good user feedback that we are getting on the app itself. So thank you so much for that. If you do like this channel, if you think that we are providing something of benefit to you, something that helps you in your property journey, please do subscribe to us. Now, the 8th episode is, dare I say, it's a complicated one. Because this is the subject that I don't fully understand, and that's why we have got an expert over here. Today's subject is about depreciation. Yes. Now, I don't think myself as a property expert, but even if I did, I would be in a lot of difficulty to explain it properly, what depreciation actually is or what it does. That's why we have Tyrone from Washington Brown here with us, and Tyrone has been an expert for, I would say, a few decades in depreciation.
Thank you for making me feel old, and thank you for having at least 3. I actually started this industry, would you believe, many moons ago.
No kidding.
I know, this is true. Me and one other firm, Washington Brown and Napier and Blakely, were the first.
Tell me about it. Tell me about it.
Well, when I was 17, I wanted to be an architect. I didn't get the marks, but I was really good at maths, and I was really good, and I also loved building and construction. And someone said to me, well, you didn't get the marks, why don't you do this thing called construction economics?
Construction economics.
At UTS, okay?
Oh, nice.
So I did that for 2 years. It was a 4-year degree. I did that for 2 years. And then I deferred for 3 years, and I did what all good young Aussies should do, and I backpacked around the world. And the number one thing I learned from backpacking was that I never wanted to work for minimum wage again. So I came back, and I finished my degree. At that point, I was 23, 24, and I thought I was really old to get into the industry. And one day I went to university, and on the columns there were these job ads that said, cadet wanted, Washington Brown. I thought, that's a fancy name. This is before seek.com.au, right? So I because I felt old, I thought, I've got to get into the industry. So I went and stole all the job ads. So I was the only one that turned up. Right? And it's a true story. So then at that point, I said to Tony Brown, who was the Brown in Washington Brown, he'd already been running the company for about 10 years. I said to him, look, I'll work for you voluntary for a year just to get my foot in the door. And in my final year at uni, I wrote a thesis on property depreciation, right? And it was dormant. There was no one, it wasn't really a thing yet at that point. But in 1997, the ATO put out a ruling that said, if you don't know the construction cost, we'll accept an estimate from a quantity surveyor. I'm like, woohoo! I just wrote a thesis on this. I'm going to start. So I left Washington Brown and started my own company called Property Depreciation. Not Property Dollar, Property Depreciation. And I rang up every developer and said, hey, I can help you sell your developments with this thing called depreciation. And it grew and grew and grew. And then the Tony Brown of the Washington Brown said, hey, let's merge again. And we did. So I came back as a 50-50 shareholder in Washington Brown. And then my side of the business went, and then I bought him out. So that's how I ended up with a 45-year-old company, even though I'm 53. So I didn't 54. So I didn't start it when I was 2. So that's how I ended up with Washington Brown. So at that point, no one was really doing it. So I started this industry with another company called Napier Blakely.
Can I pinch you just to realize that you are the innovator
the goat.
of
So I did a podcast.
We have here in my studio, how dumb of me. We have here in our studio someone who invented depreciation in Australia.
Well, I didn't invent depreciation, but I certainly invented
The whole methodology.
yes, of the depreciation of
We have a lot of investors who will be thanking you today.
Well, I hope so. We've actually, Washington Brown has now saved over 300,000 property investors pay less tax because of depreciation. That's how many investors we've had over the last X number of years.
That is awesome. Wow, thank you so much for accepting my invitation, man. Thank you so much. All right, now, having said that, look, I don't understand this depreciation thing for all those new investors, first time buying their investment property, not the owner occupiers. I mean, they should also listen to you. But for the new investors, can you please explain what depreciation is?
Okay. So firstly, yes, in order to claim depreciation on a property, it has to be an investment property. You can't claim, if it's an owner, I get asked this all the time. If you live in the property, you can't claim depreciation. But what depreciation is, it's like if you're a tradie and you buy a ute for your business, you claim the wear and tear of that ute against the taxable income of the business. It's the same thing in property. You'll claim the wear and tear of the property against your taxable income. The difference is that with property, you have to base it upon the construction cost, not what you pay for it for a large portion of it. So when you buy that Toyota ute, you don't ring Toyota and go, hey, what it costs to build that ute in China, or Japan in Toyota's case. But in property, you ring up a quantity surveyor like Washington Brown and say, how much did it cost to construct that property? And that's part of the basis of what you can claim. Now, how it works, if we were to write you a report that says you can claim $10,000 in depreciation, that reduces your taxable income. You don't get a tax check from the ATO of $10,000, you get a tax refund of $10,000. And what it's called is a non-cash deduction because it's already within the property, right? Like every other deduction that you have to pay out, whether it be your strata levies, your property management fees. The depreciation is non-cash because it's already within the property. You just need someone like me to work out how much it is. And that, as I said, reduces your taxable income.
So if someone is on a bracket, income bracket of, say, for example, $180,000 and they show a depreciation of $10,000, they will get down into another tax bracket, down one below, and then they will be taxed on that bracket.
Yes. So, and the higher the bracket you are, the better depreciation works, right? So if you're on the 47%, you're going to get a tax refund of $4,700. If it's in your super fund, it's only going to help you 15%. So yes, the higher it is, the better.
100%. Okay, and that's how it's beneficial for investors.
Yes.
Right? Because for investors, you would think that the property as an asset is also a business. A lot of smart investors treat property investment as their own business. Would that be the right thing to say?
Absolutely. But and also it's not just for residential. This also covers commercial, industrial, etc. So it's it's not just residential. How it helps.
Awesome. What can an investor claim in depreciation? You did touch on construction.
So firstly, there's pretty much everything. I'll explain that there's really only three things you can't claim, which are demolition of the property because it's removed, so you can't claim that. You can't claim the site clearing when you clear the site, and you can't claim development profit. You can't claim the profit of a developer can't throw in his profit. But everything else, from the bricks, the concrete, the ovens, the dishwashers, the blinds, even things like the design of the building forms part of the construction costs. Even the council contributions that you pay form part, not many people know that, but that forms part of your construction costs, and that can be claimable.
The design of the building as well?
is part of the construction cost. Now, how it works, we separate the building into two components. There's the structure of the building, which is the Division 43. That's the bricks, the concrete, the roof. That stuff's according to the ATO, will last 40 years. And you get to claim that at an even rate over a 40-year period. The second component is the ovens and dishwashers, and they have all varying rates because they are going to wear and tear quicker. Right? It makes sense that carpet is going to wear out quicker than bricks. So the ATO recognises that you claim carpet over 10 years as opposed to 40 years. So a depreciation schedule, in essence, breaks it all down into the components that you claim and puts the rates upon it. Now, there has been a major change in the law in this regard.
Yeah, I heard.
Right? And so It hasn't affected the structure of the building. The bricks and concrete hasn't changed at all.
For the audience, can you just clarify what that law is?
The major change in the law happened in 2017. That the government said that if you buy a second-hand property now, even if it's 1 day old, you can no longer claim the ovens, the dishwashers, the blinds, all that plant and equipment stuff. Even though the government says the carpet may last 10 years, and if I bought it brand new, I can claim it for 10 years. But the moment I sell it to you, 1 day later, you can no longer claim it. It's a silly law, but that's what we've got to deal with, unfortunately. And it also is even more silly. I could use words harsher than silly if you ask me, but I'll pretend this is a nice show. Not really. But they didn't change it for commercial, industrial, and retail property. So this only affects residential properties.
Do you think they're doing this to encourage people to buy new properties?
Yes. So partly that. And so they didn't change it for brand new property because the government would never want to stop construction because it has such a flow-on effect through the economy, right? It said that if you spend $1 in construction, it has a $10 flow-on effect throughout the economy. Now, a big part of how developers sell property is by showing investors that it's cash flow positive before it's even started, when you start on the ground. Now, depreciation has a big part of that in the brand new properties market, right? But the moment that it's 1 day old, they're not scared so much. So they want to get activity off the ground. So they'll never change it in my view. Never say never, but they'll never change it for brand new property.
Can I ask you one question? This is a personal question for me as well. When someone buys a brand new property, how long they have to wait to book a depreciation? Can they do it the second day, or because it has taken time for the newly built construct?
Yep. Good question. So we work with lots and lots of developers, and a lot of the clients, they order it before they've even settled, but we need to know the settlement date to give you a report. You can get on the date. If you ring us, if you settle, we can give you that report straight away. Right? We need to know the settlement date. Because we work with big developers like Merritt and Daycor and all these people, we've got the costs. So we're ready to go the moment you settle. But settlement dates change sometimes. So the moment that you settle, that's when we calculate how much you can claim. But if you came to us 6 months later, the report won't be any different. We backdate it to when you settled, regardless of when we do the report.
I understand.
Right.
So say, for example, someone has bought an off-the-plan property in Sydney or Melbourne.
Yes.
And it's a beautiful new, I would say, apartment. And they settle on, say, for example, 30th of November. They can come to you on 1st of December?
Yep, absolutely.
And you can do it for a year? Or whatever that is.
Just one tip or one warning I would give people about these new law changes is, as I said before, if it's second hand, you can't claim it. Now, I've had some clients come to me that have bought, say I bought it brand new, say I bought it off the plan today, right? And 6 months before settlement, so settlement's going to happen in a year, but in 6 months' time, I sell it to you, right? But you haven't settled it. No one's settled yet, right? But I've sold it to you on sale before the settlement. What happens on settlement day is I settle off the developer, then you settle off me on the same day, right? In the eyes of the law, even though that apartment has never been opened, it is second hand. It's even though the oven's never been used, because you didn't pay GST. And that's the determination of whether the property is brand new. So we get clients ring us up, say, hey, this is new, why haven't you got the depreciation? We look at the contract, say, because you didn't buy it from the developer, no GST has been paid, it is second hand. And unfortunately, a lot of people are getting caught by that because, and in the agent's defence, they don't know, they wouldn't know that, right? So tip to, if you are buying it off the plan, or brand new, make sure you're buying it from the developer if you want to claim. And it's a big deduction. It can be like $50,000 in depreciation,
that's
right?
That was my question. Like, is the cost difference too much in the depreciation? Well,
okay, to give you an example, if you were to buy a $1 million apartment in Sydney, if it was brand new and you were claiming the depreciation, you'd get about $20,000 in year one. If I sold it to you tomorrow, you'd get about 10.
Wow.
Roughly half, straight away.
Wow.
So it's a big, like that's $200 a week, right? It's significant.
Keep holding on to your property.
Well, another thing is I'm finding a lot of people when I do a lot of seminars, and a lot of people come up to me and say, hey, look, I bought a brand new property. I'm going to live in it for 6 months to get the grants, right? And that's good. Problem is, once you've lived in it for 6 months, and then you move out and you rent it out, it's second hand again. So you've missed it. So even though you might get a $10,000 grant, you missed out on $50,000 in depreciation.
Sorry, say that again. Okay. Please say that again.
So if you were to buy a brand new property, right?
Okay.
And you live in it to get the grants, because you've got to live in it for some of the grants, live in there for 6 months, right?
Yeah.
You've now, all those ovens and dishwashers and plant and equipment items, you can't claim because you've used them and they're second hand. So, and in an apartment of, high-rise apartment of $1 million, you'd probably get about $50,000 in depreciation. So you might have saved $10,000 getting the grants, but you've missed out on 50 grand I shouldn't laugh, $50,000 in depreciation. So you need to factor those things into consideration.
Property investment is not easy, is it?
It's not easy. So they seem to have fun making it harder.
That's one tip. Can you give me like 2 or 3 more tips for investors?
Sure. Okay. One, there's a thing called scrapping. Now, if you were to...
Scrapping?
You're scrapping, lad. Scrapping. So if you were to remove items, so the government says that stuff like kitchen cupboards and built-in wardrobes and shower screens are going to last 40 years. Doesn't always happen. Physically, they may. But if I was to buy a property that's, say, 20 years old, and I rent it out for a year or so, I say, you know what, I want to put a new kitchen in, right? Well, what I could do is once I remove that kitchen, I could claim the balance of that whole kitchen once I remove it. So, because the government says it's going to last 40 years from when it was built. It was 20 years ago when it was built. It might have cost, say, 20 grand for the kitchen back then. 20 years later, there's still $10,000 left in that kitchen. Now, if I remove, because it's halfway through its 40-year period, right? If I remove that kitchen, ring Washington Brown, get us to value it before you remove it, and you could get an immediate $10,000 deduction. Plus, when you put the new kitchen in, start the process again on the new kitchen. So a lot of deductions go into the sky because people don't know that they can do that.
Wow, that's quite detailed, man.
A little tip is a simple one. If you buy things that are under $300, you get an immediate deduction. Now, if you're going to buy a microwave for your apartment or your house, buy one for $299, not $301, because you get an outright deduction rather than claiming it over 10 years. Right? And I don't think your tenant cares about a $299 one or a $300 or a $301 microwave. No. Simple tip.
I've been using Kmart microwave. I could have got it actually like for $50. But wow, you can't Google these things.
You can't Google these things.
Wow, that's amazing. Now, this is an important question. I think I got an answer from what you have said previously, but just to clarify, can you book a depreciation on older properties?
So the answer is yes, you can. But now, if it's built after... Firstly, we've got to categorise it into what type of property. So all commercial, industrial, retail, 100% you can still claim all the ovens, all the roller doors, all the air conditioning, all the carpet hasn't changed, if it's non-residential. If it's residential, you can still claim the structure of the building, provided it's built after 1987. So if it's built before 1987 and there's been no renovation, no, I can't help you anymore. We used to be able to, because we used to go out and revalue all the plant equipment. Now, which is the ovens and dishwashers, now it has to be built after 1987 or renovated, and then we can work out there'll still be a worthwhile report in it.
Wow, wow. Wow, there's so much information over here. And there's so much I didn't know.
How do you think my head is?
Now, I got someone who is so knowledgeable in this kind of field. I want to know, how do you invest? What has been your investment journey? If you're okay.
Well, yeah. So look, I started with nothing. I saw my father actually lose all his money back in a failed property deal back in the late 80s. He was worked all his life and he became a cripple, and he got retrenched from his work and he got a payout. Not retrenched, moved on, I guess. And he invested all in a thing called estate mortgage, which was they pretended to be safe as houses, and unfortunately they were paying 1% more in interest, and when interest rates went to 17%, it was actually not into bricks and mortar, it was into development sites, and he lost all his super. So I saw him lose everything, which was quite sad. So I guess I have been focused on property myself, trying to make that, and so I guess probably there is I didn't start with anything. But how I got into the ladder early on was through friends. I used to my first 3 property deals I did was with partners, which I think is a good way to do it. I probably would have had it structured more. There was no agreement. There was nothing here. Like one was my wife in the end, and my brother. It worked out well. But over the years, I've I've worked out the other day 22 different properties. I now have probably a portfolio of 5. I've tended to upgrade. I've bought things. I've bought offices. I've bought some of it has been in development sites that I've been working on with developers. So it has been a good, being involved in the industry has certainly not hindered my investment process. If I had to categorise what I've done, I've tended to buy when others aren't buying. I've tended to do the opposite of what people are doing. I tend to. I remember one time I was at an expo at Darling Harbour, and there was 300 people lining up to come to an expo, and I thought, this is crazy. Like this is the euphoria, right, of people wanting to buy. And I put three of my stock properties on the market the next time. I'm tapping out. These are the ones I could, they're not the blue chip ones that I have that I sold. So I guess my morals in my story has always been to ignore the noise. When I see the papers, everything, property's always going up. I'll just sit back and wait. I hate going to auctions where there's 100 people. I know that good times will follow bad times, will follow good times, right?
Yep.
And I tend to wait. And also then I've sold, so I've got virtually hardly any gearing now, like 2% geared, because when I've sold, I've just put it into, building the next house and building up to, and I guess an owner-occupied property, we have a pretty good law in this country where you don't pay, capital gains tax on if you can keep upgrading your owner-occupied property. 100%. I know it's really hard. I feel really sad for the generation. I look at my daughter and I think, without my help, how on earth can you get into the property market these days?
Yeah, it's very, very difficult for first-home buyers now.
Terrible.
And young people to get that. I mean, I was reading the report where I think, don't quote me on this, but it will take 7 years to save a deposit. It's unreal. Like at Property Dollar, we are passionate about actually bringing the age of first-home buyers, say for example, from 33 to let's say at least 31. At least bring it by 2 years, so that because when first-home buyers get into the market, it trickles down to the rest of the economy as well. It helps everyone. If everyone has home, it helps everyone. Absolutely. But I completely agree with you on that point, because I think you have seen tough times, right? And then you have made something really good out of your life and for everyone else as well. What are the things that investors should avoid? One, I know you would say that avoid the noise. Avoid the noise, absolutely.
Yeah. Avoid the noise and feel the FOMO effect of property. I think that's probably the biggest mistake investors make. I think, because I know so much about the mathematical side of property, I think people should try and get an understanding of what happens when you sell a property. The exit, what it actually costs you to know to invest in property. You should know the end equation as well, if you ask me. Educate yourself in that regard. And another thing I see a lot of people make mistake of is not knowing that if they sell the property within 12 months, they're going to pay heaps more capital gains tax. They're not going to miss out on the capital gains tax discount, right? Which is 50. It goes from 25% to 50%. So I think people should be aware of that number one factor. I see sometimes in the paper, I see investor buys $500,000 property, sells it for $470,000 in 4 years. In 4 months, made 70 grand. I'm like, no, you didn't make a cent. Once you add in your stamp duty, your selling costs, and because you held it for that long, you made nothing, right?
And interest cost
and all that stuff. Yeah. So sometimes flipping might look good if you just use the bottom number and the top number and don't include any of the other costs.
It's cost of buying and cost of selling and cost of holding that I think investors should keep in mind.
And as a quantity surveyor, one of the other things I see a lot is overcapitalisation of construction costs. We look at, because we ask a lot of investors, well, if you renovate a property, you have to give us your costs, right? I've seen literally a Paddington Terrace, one and next door one, right? Same, because we've got the cost. Someone might spend $200,000 and the next person might spend $1 million and they look exactly the same. And it's like, unfortunately, you're going to get the same price, so anyway.
It's Italian marble.
Yeah. That's right. Exactly.
So what's the best investment advice you yourself have received and from whom?
Okay. Well, that's a no-brainer for me. So one of my clients is Harry Triggerboff, who owns Meriton Apartments. He's been a client for 25 years. He's worth $26 billion. To put that in perspective, if you were to merge Suncorp Bank and AMP Bank, you still haven't reached his net wealth, right? That's
wow.
Okay, so that's Harry. So one time I was at lunch with him, and he said, Tyrone, when Harry speaks, he ends his sentences with a bit of a higher intonation. Right? And he said, Tyrone! He said to me, he said, do you want to know the secret to my success? Now, I'm not going to say no, right? Of course, Harry, what's the secret to your success? He said, Tyrone, he said, when times are bad, I buy land. By the time I get development approval, times are good again, right? Think about it. So when times are bad, I buy land. 3 to 4 years later, when I get development approval, times are good again.
Yeah.
So what does that mean? I mean, ignore the noise, right? Back yourself. If with him, yin, when others are yanging, right? For someone like Harry, because he develops the land, buys it cheaply, develops the land, and then keeps half his stock, for him it's not a case of whether you time the market or whether you have time in the market. He does both, right? He times the market and then has time in the market because he keeps half his stock. And if you can do that, I reckon you found the Holy Grail.
There you go. That's the secret, huh?
That's the secret.
One question before we end up this one is, and I've read this in a lot of Facebook groups. Hey, listen, I want to order a depreciation report. Do I need to have a physical inspection? Yes, no, every time?
Well, you used to, but now with the laws change, so the answer is yes and no. So we analyse the property before advising the client whether they need an inspection. For example, we've got the costs on every Meriton building. We've been doing this for 30 years. I've got the actual construction costs on so many properties, right? So me going out to see a property that I've already got the cost is not going to be of benefit to you. So we will analyse the property and say, yes, we recommend an inspection. Or, look, we've already been there. We've got the cost. There's no benefit to you because you can't claim the ovens, and if that's been replaced, it doesn't matter anymore, right? We're all just doing is the structure. And now if I got the structure, I'm not going to charge you to go and look at some bricks that I don't need to when I've already got the cost. So we pass that saving on to you. So we'll charge you a reduced fee because we've already got the cost. So the answer is yes and no. But we believe in analysing the property beforehand and telling you and advising you the best strategy to maximise your depreciation at the best optimal price for yourself. That sounded like an ad.
Awesome. Speaking of that, I gotta say some things about Property Dollar as well. That I'm so glad that Washington Brown has now joined hands with Property Dollar.
Me too.
And we have a calculator placed inside our app for all Property Dollar users that will give you an approximate depreciation amount that you can sort of claim on your investment property. Having said that, if you want a detailed report, you can actually, through the Property Dollar app, apply for a detailed report wherein folks from Washington Brown will come. If there is a need of physical inspection, they will. And if there isn't, they will do a desktop kind of depreciation report. And guess what? All Property Dollar users will get a discount. They will get a report at a discounted rate because we love Washington Brown so much and they love us so much, right? And in fact, I gotta tell you, like, we made this calculator live last week, and Naseem, our head of product, he was saying that, hey, listen, we went live with it and we sent out the push notification. 1,000 people in 2 days used that calculator.
It's pretty cool.
Yeah, 1,000 people. Because I just wanted to know how much we can claim. Because it feels like it's an immediate cash, right? And I think 5 or 6 people have already applied for that. So guys, if you haven't downloaded the app, download now. And once you download, if you have a new property, upload that property and immediately apply for your depreciation report, like now. Okay? Thank you so much, Tyrone. Thank you so much for your time today.
Very good. Thank you.
Thank you.
Appreciate it.